You've been waiting for mortgage rates to crash just because the Federal Reserve cut rates. You're not alone. Millions of people are asking the exact same question right now. The Fed is cutting rates. Why are 30-year mortgage rates still stuck in the sixes and sevens? Today, I'm breaking down the real relationship between the federal funds rate and your mortgage rate, why they don't move one for one like most people think they do. And what actually drives mortgage rates 2025 and beyond? Stick around until the end because I'll tell you exactly what to watch for instead of the Fed if you want to predict mortgage rates. Hit that like button if you're tired of bad financial takes, and let's dive in. First, super quick refresher. The federal funds rate is the interest rate that banks charge each other for overnight loans. That's it. One night. When the Fed cuts the federal funds rate, it gets cheaper for banks to borrow from each other. That usually lowers short-term borrowing costs, credit cards, car loans, HELOCs, some business loans. But here's the key. 30-year fixed mortgage rates are not short-term loans, and they are not set by the Federal Reserve. And it's a really common misconception. Everybody sees the Fed rates go down. So who actually sets mortgage rates? The bond market, specifically the 10-year Treasury. And the 10-year Treasury real tracks almost perfectly. Why the 10-year loan? When investors buy mortgage-backed securities, big pools of home loans, they're locking their money up for decades. They compare that to the safest long-term investment in the world, the 10-year Treasury note. So the simple formula is mortgage rate equals 10-year Treasury yield plus a spread, usually 1.6 to 2.2 percentage points in normal times. But if you put the 10-year Treasury yield and the 30-year mortgage rate on the same chart for the last 20 years, they move together like twins. Now put the federal funds rate on that same chart, totally different story. Bottom line, the Fed controls the short end of the curve. The bond market controls the long end of the curve, and that's what matters for your mortgage. So why do mortgage rates stay high even when the Fed is cutting, which is what we're seeing right now? Here are 5 real reasons we're seeing right now in 2025. Number one, the bond market is forward looking. Bond investors don't care what the Fed did yesterday. They're pricing in inflation and growth 5 to 10 years from now. If they think inflation is still sticky or the economy is going to reaccelerate, they demand higher yields. Higher mortgage rates is what you're thinking about. Number two, the yield curve is normalizing, or in some cases, still doing weird things. After years of ultra low rates, and then the fastest hiking cycle in decades, long-term rates can actually rise while the Fed is cutting the short end. We call that curve steepening. It's normal, but it keeps mortgage rates elevated. Number three, mortgage spreads are still wide. That gap between the 10-year yield and the actual mortgage rates is bigger than usual because of the prepayment risk, servicing costs, and investors are just wanting a little extra yield after the chaos of the last few years. Number four, massive Treasury supply from deficits. The government is issuing trillions of new debt. Someone has to buy all those bonds. To attract buyers, yields have to stay competitive. Number five, global demand for US Treasuries isn't what it used to be. Less foreign buying equals higher yields. They have to give higher rates to attract investors. So when the Fed cuts, the bond market can literally shrug and say, cool story, but we're still worried about inflation and deficits years from now. Mortgage rates follow the bond market, not the Fed. We've seen this movie before. 2004 to 2006, the Fed was hiking aggressively. Mortgage rates barely moved. 2019, the Fed cut rates 3 times, and mortgage rates actually went up for a while because the 10-year Treasury yield rose. The Fed matters, but it's not the puppet master of mortgage rates. So what you should actually do if you want to know where mortgage rates are headed, 4 things. The 10-year Treasury yield, obviously, inflation expectations, especially the 5-year 5-year forward, or break-even rates. Mortgage-backed security spreads, when they widen, mortgage rates go up even if treasuries don't. Economic data surprises. If jobs, wages, or retail sales keep beating expectation, long-term rates stay high. If you've got any questions about any of this stuff, reach out. I would love to answer anything. I'm not the smartest person in the room, but I try to pay attention to the data, obviously follow the 10-year treasury. Bottom line though, the Fed cutting rates is great for a lot of borrowing, but don't expect 30-year mortgage rates to fall off a cliff just because the Fed funds rate dropped 0.5%. Mortgage rates live in the bond market, not in Jerome Powell's press conference. If this cleared things up for you, smash that like button, drop a comment with your current mortgage rate or the rate you're waiting for, and subscribe to notifications because I try to update people with information just like this. Hope this was helpful, guys. Reach out for more info. Talk to you soon.